right, welcome everyone. We changed up the music intro to add a little more energy. We wouldn't want anyone to fall asleep. This is Money Talks. I'm Greg Vogel, Portfolio Manager at GKV Capital Management. This week we're going to give a quick recap for the end of the first quarter. We'll go into a few thoughts about earnings expectations and where we think the markets are likely to go from here. But first, last week was a big week. There was a spectacular blow-up of the Archegos hedge fund, the Ever Given cargo ship stuck and freed in the Suez Canal, the massive Biden administration infrastructure and tax increase proposal, the continued craze for both SPACs, special purpose acquisition companies, and NFTs, which we covered last week, and lastly, a big change in the user experience for the Robinhood app with the elimination of confetti. So much to talk about, but we're going to keep this short. So out of all the pressing topics, confetti sounded like the most fun to us. Robinhood's a discount broker that is focused on a young, digitally savvy clientele. Users can download the app to their phone, fill out the brokerage form, link a checking account, transfer funds, and be trading within 10 minutes. The user experience is very simple and very user-friendly. Trading securities can be intimidating, but Robinhood has done a remarkable job of making the process easy and approachable. The company promotes itself as democratizing Wall Street. The ease of use has created a side effect, however. The app is so easy and fun to use that many critics fear a gamification of Wall Street. I went and opened an account for myself the other day, and it's worth sharing the experience. I'm on an iPhone. After downloading the free app from the Apple Store, the application form is easy to complete and submit on the phone. Here, I link a checking account to fund my Robinhood account. I picked $500 to start since I don't want to get in over my head. With the account open and funded for the first time, I get rewarded with confetti. Pick one of 3 scratchers to see what stock I win for successfully opening and funding an account. I was hoping for Amazon. Clearly, I picked the wrong scratcher because I ended up with 1 share of Spectrum Pharmaceuticals trading at $3.37. Robinhood advertised winning 1 share of Microsoft, which would have been better, or even Ford Motor trading at $12 per share, but I'll hang on to my share of Spectrum. If you want more free shares, you can refer friends. If they sign up, you're awarded more shares. Robinhood certainly makes it more fun than the typical banking or brokerage experience. Browsing through the investment selection area, the popular categories appear at the top: crypto, including Bitcoin and Ethereum, or the 100 most popular names on Robinhood. They're the usual suspects: Tesla, Apple, AMC Theaters, Chinese electric vehicle manufacturer NIO, GameStop, Disney, Microsoft. The popular in-play retail names are at the forefront. Another innovation of Robinhood that simplifies stock ownership for small investors is the ability to purchase fractional shares. I bought 200 shares worth of JP Morgan, and I get more confetti for buying my first stock. My $200 bought me 1.3 shares of JP Morgan. I put most of my remaining cash into Bitcoin. The Robinhood app does a great job of showing my gain and loss in real time with second-by-second updates. It's so good that I found myself checking the performance of my $500 portfolio several times throughout the day, despite the fact that I'm managing more than $200 million in assets. It's really addictive in a fun kind of gambling sort of way. Robinhood has made retail trading cheaper with zero commission. Fidelity and TD Ameritrade and others have been forced to follow suit. Certainly the app is friendly and usable and fun, and one can argue that it does indeed make investing in securities far more accessible. I don't believe Robinhood's doing anything wrong. This isn't meant to be a criticism of the app, the brokerage, or its customers. It is important, however, for investors, all investors, to understand how a subset of market participants and their approach to investing has altered the market. We expect there to be more of the meme stock phenomena we had this year, similar to the run-up in GameStop, AMC Entertainment, and even Tesla, resulting in periods of extreme volatility for individual companies. The army of Robinhood video game market gamblers will continue to grow, and the effect is something we all need to pay attention to. Robinhood's getting ready to go public. They're trying to address the criticism that they're making investing more like gambling, or at least like playing a video game. As a result, they're doing away with the confetti. I'm skeptical that the confetti is the issue. With or without the confetti, the draw of instant gratification, am I up or down, for each moment of the day is addicting. Our phones are indispensable. I check my voicemail, my email, my texts, look for news alerts, and oh nice, my Bitcoin's up 50 cents. Welcome to the always-on, instant information digital world. A portion of investors are in it for the thrill. That was true of some investors at old school brokerage firms, but it seems more prevalent and amplified by the internet. Look, to be fair, it's worth noting the blow up last week of the Archegos family office, which had leveraged about $10 billion to an estimated $50 billion or more before margin calls forced the sale of significant positions at market lows. Here's a highly sophisticated investor, Bill Wang, and several banks that provided excessive leverage with disastrous results. They're clearly no more capable than the Robinhood retail investors speculating on penny stocks. So I want to wrap up with a look at the market's performance for the first quarter ended March 31st. Compared to last year, the broad equity indexes seem tranquil. We welcome the lower volatility, and the results for the first quarter were very positive. The broad S&P 500 index finished the quarter up 5.8%. Rising interest rates definitely had a negative impact on bond prices. The U.S. aggregate bond index declined 3.4% in the March quarter, as interest rates nearly doubled since the start of the year. We expect this poor performance in bonds to continue this year. The best performing major index are the U.S. small cap companies, which stand to see significant growth with the full reopening of the U.S. economy. The Russell 2000 ended the quarter up 12%. Cyclicals and companies beaten up in the pandemic were the best performers. Energy gained 29%, while financial services gained 15%. Banks will benefit from the rising interest rates. Higher rates enable banks to be more profitable on the spread between deposits and loans. After the big returns in tech last year and relative cheaper valuations, we anticipate continued outperformance from sectors that were left behind in the height of the pandemic. Well, here we are in 2021, and the expectations for a strong recovery this year appear to be accurate. Earnings are forecast to grow 40% over the pandemic-depressed earnings of 2020. The positive expectations for a strong 2021 were already set last year, and the price of stocks moved higher to discount this year's strength. If expectations for strong growth can continue into 2022, then stocks can set further new highs. Of course, there's always risks, rising interest rates, likely tax increases, and there's always unanticipated events, but strong economic growth should continue to drive equity prices. Next week, we'll take a look at the tax hikes and the proposed $2 trillion Biden infrastructure plan and the potential impact on the markets. Please feel free to leave any comments below. Thank you very much for joining us.